Hello, everyone, and welcome to the April edition of Kingdom Focused Financial Economic Update, featuring Chuck Etzweiler, Michael Smith, myself, Derek Malden. Take it away.
Hey, thanks, Derek, and welcome back, everybody. I say welcome back because I'm assuming you've gone and watched the updates we've given every month so far this year. And if you haven't, you should, because we're continuing on in a theme that we started this year, in anticipating what we think are the forces that are going to make and shift this market. And it's a little bit trickier this year because of the midterm elections, and now we have a little bit of a conflict happening globally as well. And so those two things combined make it a little dicey. So I hope you go back and pay attention because there's multiple aspects. It's not just a simple check the box market this year, but we're continuing. And so, Chuck, I know you're here and looking forward to you sharing with us some of the insights that we've been talking about. And this month we're diving into our wiser theme, dealing with the I, the second phase of that, the I. So, what do you have for us this month, Jim?
Thanks, Michael, for the kind words. Great to be with both you and Derek, and certainly our listeners. We're at the I already in the 5-letter acronym WISER, as you teed it up really well. Remember the W's, Washington, D.C., midterm election year, headwinds typically happen. And I think we're seeing that play out right before our eyes. The I was an intriguing one to us because it's interest rate policy. And if you remember back, Michael, the question was, will the new look Fed get to 3% more quickly? That's a question mark, but let's not get ahead of ourselves, right? The new look Fed has not even been implemented just yet. We will wait until May, assuming Kevin Warsh, yes, there is an R in that last name, Warsh, has been nominated by the president. He has to go through the process. Let's assume he does get there. Then we have another big question mark, and that's whether Jerome Powell stays on as Fed governor. He can so choose to do so. We've talked about historically the precedence is not there. Only 2 Fed chairs, formerly chairs, stayed on as just a regular Fed member. You got to go back to 1914 and the Great Depression following that, 2 gentlemen who have stayed on. What typically happens is when you get the Federal Reserve having 3 to 4 members of a current administration, they will follow the lead. And our thought was President Trump certainly wants lower rates. And if they're justified, maybe this Federal Reserve will get there quicker. That remains to be seen, but we're still certainly holding on to that. So that begs the question, gentlemen, what sectors do well when the Fed is cutting rates without a recession? I don't think there's anybody who is calling for a recession at this point in time. We're certainly not. So it kind of begs the question. We went back and looked at the most recent Fed decisions. Certainly there was a pause in the most recent Fed decision, but before that, at the end of last year, we did have a rate cut. But interestingly, guys, you'll see if you look at the dot plot matrix, there's 7 members who project no cuts this year. Actually, 3 project hikes, but there's 8 that actually project 2 or more cuts. So it will be dependent upon Kevin Warsh being nominated, Jerome Powell stepping aside, and also let us not forget the Lisa Cook case, which has gone before the Supreme Court. We need to wait for that decision. If we get 3 new members and all are more dovish, meaning they tend to cut quicker, we could see financials outperform as a sector. And one of the slides that we've put together for our investors kind of shows that historically, going back in time, that when the Fed cuts, again, assuming no recession, financials actually outperform the overall market. Now, think about this. When we put our money in a bank, we get paid interest. When rates come down, it's not good for you and I because our interest payment is lower. However, it benefits the bank. They pay us less in interest. That's their cost of funds. Yet they can still charge a higher interest rate on the longer end of the yield curve, as we call it. That's where loan rates are based on. The interest margin spread of banks widen. Asset managers tend to do better. Why is that? There's $7 trillion sitting in money market funds, earning decently 3.5%. Those are not profitable entities for asset managers. However, if that rate comes down quicker, those rates don't benefit the money market fund holder because they get to 3 or 2.5, but they certainly benefit the asset manager because those investors most likely will shift to stock and bond funds, which are more profitable. And certainly, if we get mergers and acquisitions picking up, initial public offerings, that helps what we call investment banks. So the longer story here, to be made short, gentlemen, is that historically financials begin to outperform when the Fed starts this rate cut cycle, which we can make the case they really haven't because we haven't gotten, as you said, Michael, to the new look Fed just yet. But let's assume we do in May and we look down the quarters of 2026, 3 months, 6 months, even 12 and 24 months out. That's when you see financials outperform. So what we've done, at least in the model portfolios, we've brought financials from an underweight, which they were last year, up to a neutral weight. So it's not that we're overweight in financials, but we're kind of waiting to see what happens with this new look Fed and where they go with interest rate policy. Here, this is the April podcast. In the middle of May is when Jerome Powell's term is up. Assuming Kevin Warsh goes through the nomination process, will be sitting in that seat. We'll probably have the Lisa Cook decision on Supreme Court, whether her firing, her dismissal was done vis-a-vis cause or not. We could have 3 open seats. We could have 3 more dovish, if you will, Fed seats that now occupy the decision-making process. And I think we probably get those cuts in the back half of the year. That spurs financials and hopefully our portfolios we position to take advantage of that. So,
Yeah, and
Michael,
Chuck,
you probably have some comments on that, sir. Go right ahead. Sorry.
yeah, no, perfect. And you called it out beautifully. And I want to remind everyone, 2026 is 12 months, right? A lot of times we want to see all of the gains and returns right now, right? And what's happening. But history shows the market, it's like a boat on the ocean. It rises and it falls with the waves on its way to its destination. And hence why we're our theme, right? Wiser. There's 5 key components this year that in the mix, and not all of them show up in January. And so we were expecting. We didn't think a lot would happen with interest rates before the Fed chair changeover took place. However, the conflict we're having right now may actually help influence rates coming down if it's pushing inflationary pressures up even more. And then the other thing I'm going to add to that, if rates do come down, volume makes a difference, and lower rates also means more large companies, small companies willing to borrow to fund new ventures, to fund new initiatives, which
Absolutely.
fuels and fosters more growth. So you got to put all these components together and how it looks. You said it well. Where are we? Well, we think interest rates are a key mover this year. And so we've positioned ourselves in a place that we can pivot. We can go forward, we can go back, but we're sitting there at the starting gate, ready to make a move when the interest rate impact shows up this year.
You summed it up very well, Michael. Well said. And I think as we get to the back half of the year, we'll be rediscussing this topic, hopefully with big smiles on our face and made the right call for our investors.
Chuck, tell me a little bit about um, performance longer term when financials do kick into gear. You hinted at it that it's kind of delayed and coming down the road, but it also tends to be a little bit of a longer pull on the market as well. It's not like a flash in the pan. Am I right on that?
It is, yeah. We've done a lot of research on this, and I kind of gave the time frame. You're correct, but I didn't give the turns or the outperformance. You get that initial bump when the first rate cut happens, non-recession, 3 6 months, but then the tail of those returns really stretches out to the upside, and you can actually see outperformance 4 to 6 to 8 basis points, which is pretty significant. So that basically means if the S&P is up 10, financials could be up 14, 16, and 18. And historically, it can last up to 2 years, Michael. So it's a really good observation. It's not just the length, but you think of the return outperformance and that cumulative effect over time adds up.
It does. It does. Um, Chuck, what else? Anything else you want to add to this high theme as we move forward? I mean, we kind of laid it out in terms of where it sits. It could be a very, very powerful one, and we're positioned and watching and anticipating it in our portfolios this year. Anything else that
Yeah,
goes into that?
I think you stated it really well in a summary form. I'll just say this too. So if you think about where we were last year, we were underweight financials. The Fed was still kind of making decisions whether they're going to raise or cut. We moved the position to neutral, so we're at the benchmark, and we're poised, even kind of in this short-term positioning, to add to it if what works out in the back half of the year is what we think is going to happen. So I would just leave investors with that. There's room to maneuver here. And we still are very bullish in this sector. And we'll wait to see what happens here. We walk through 2026 together.
Perfect. So for those of you watching, I hope this was helpful in sorting out just one of the 5 major factors that we think will impact things this year. Certainly, as we're taping this, there are 2 very key things already in play. Washington, we talked about it, the W, and the conflict that we're having, and how short or long that is a variable that will impact, and we'll certainly talk more about that in next month's update. It could even be done and over by next month's update, as these things tend to really sort of spike and disappear quickly. And so we're watching, we'll see. But the longer term play is the midterm election, where we talked about the Washington impact. And so for you to put it in perspective, this is one of those years where I'm going to encourage you not to look at your accounts every month, because I firmly expect it's a boat on the ocean. Going to be up one month, it's going to be down one month. And I think you're going to see extra volatility as we get through this year, as the market tries to sort out these different pieces. And until it gets to the known factors, especially post midterm election. So we got to get to that October, November, and into December for a strong, solid finish to the year. Expect that you're going to see a little bit more up and down than you might be used to, especially than you've been used to the last 3 years, which have been just a super tremendous performance in the overall market that's there.
Well said.
Derek, Chuck, thanks again for being here. I'm going to let everybody get going. I really appreciate you chiming in this month. And I want to wish everyone a happy Easter as well. And for us, this is an important holiday that we celebrate this month. And I hope that you choose to celebrate it somewhere in a church or at a service, giving thanks to the Lord for the victory that he grabbed over death and the salvation that he can bring to us. So thank you for being with us. Hit like and subscribe on our channel so you can continue to see regular updates, and share the news with someone as well if this was helpful to you. I hope you all have a wonderful spring. Look forward to seeing you next time. Thanks.